This is Bloomberg Wall Street Week.
The global push into infrastructure, breaking the IPO logjam in tech.
The financial stories that shape our world.
Cutting inflation without losing jobs. Do we need rate cuts? And if so, how many? Investing in a time of geopolitical turmoil.
Through the eyes of the most influential voices.
Ken Rogoff, economist of Harvard. Former FDIC head Sheila Bair. GE CEO Larry Culp. San Francisco Fed President Mary Daly.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Great Britain gets a snap election. The Fed debates whether it's gone high enough, and NVIDIA shoots the lights out again. This is Bloomberg Wall Street Week. I'm David Westin. This week, former New Jersey Governor Christine Todd Whitman tells us that small nuclear reactors may be the answer for our AI data center needs.
The demand for power of these data centers is enormous.
Nobel Prize-winning economist Paul Krugman on why he doesn't know where interest rates are headed.
On interest rates, I am fanatically confused.
And Henry McVey of KKR reports on his trip to China and what needs to come next.
They can actually encourage more urbanization.
We start with the week in the markets, where equities ended strong after a sag in the middle of the week. The S&P 500 ended up just a bit at 5304, which keep them above the Bloomberg L's median year-end number of 5,200. The Nasdaq added 1.4% for the week, while the yield on the 10-year was up just over 4 basis points to end the week at 4.46%. To take us through what we've seen this week, we welcome back now Scott Chronert. He's Citi US Equity Strategist. Scott, always a delight to have you with us. So give us a sense of what we think you saw this week. As I say, it sagged in the length and it came back at the end. What's going on?
Right. So I think what's going on is the market continues to navigate where we think we are regarding economic conditions and the read-through to Fed policy. Okay. So we're back and forth between stronger economic data, which would signal a higher for longer Fed, versus signs of softening and ongoing deceleration in inflation, which gives a little bit more confidence that you get a Fed pivot. So we're back and forth between this ongoing debate, and the data, it tends to be supportive on a transitory basis on both sides. In the meantime, we continue to have this new growth driver in town. We're now a year into this generative AI craze, if you will, and it was reinforced this week. So a number of things going on in both the macro and then let's call it the micro and new growth paradigm approach as well.
Well, Scott, as I listen to you, I wonder if that's a little bit of a microcosm of the year so far. Because if we go back and look, the first quarter, the equities were really on the march up, the S&P 500. Then it dipped at the beginning of the second quarter, and it's come back up again. Now, we went into the year expecting, 6 rate cuts, and now we're down to maybe 1.5?
Yeah. So it's really interesting the way the market is navigating this. The way we tend to think of it, and the data tends to show this, is that the growth profile and the growth influence on equities can often outweigh the interest rate influence as it pertains to the discounting mechanism and expectations for economic activity. What's been happening is that growth has been winning as more and more companies are now getting on this generative AI phase and really going more aggressively down the path of investing in future opportunities that should support longer-term growth drivers for the broader U.S. Equity markets.
And what about your views? Because you are, I'm delighted to say, one of our elves, as we call you, the Bloomberg elves here, one of the analysts. You started out the year toward the top of the pack of elves, and now you're sort of toward the bottom. Did you move, or did the rest of the pack move?
Essentially what's happened is the rest of the pack has been marking with the market move and is leapfrogging us a bit, which is fine. I think the way we're looking at it is that we're still expressing a very constructive view on the fundamental setup for U.S. equities at this point, particularly the S&P 500. But we do have to recognize that a lot has happened pretty quickly from a performance perspective, and more recently, our ongoing panic euphoria model is tripped into euphoria, which is usually not a great sign for forward performance. At the same time, we've seen valuations move higher to a point where the implied growth expectations supporting this market are getting pretty aggressive. So put us in an ongoing, fundamentally constructive view, but shorter term, we think the risk reward's pretty balanced right now, David.
What about the breadth of the market? Going into the year, we were really concerned it was so narrow. There was some hope that we were broadening out. Is it broadening out from that Magnificent Seven or whatever you want to call them?
I think it is, but not in the way that many were expecting. From a performance perspective, off of the rally that began last November, we saw areas such as industrials and financials participate quite strongly as this year unfolded. Then as we hit the middle part of this year thus far, we began to see other areas. Energy kicked in for a period of time, and more recently it's been utilities. So while tech, communication services are still your leading sectors, you are seeing different pockets of the market kick in at different times, and it ends up supporting this broader index move.
So, Scott, you mentioned actually a year ago, you pointed out it was just a year ago that a company, I know you don't talk individual companies, I'll name the company, NVIDIA came out with those blockbuster numbers. We had some more this week, but it's spread out from NVIDIA. There are some other companies as well that seem to be along for the ride. At the same time, a lot of other companies are spending money right now. They're investing money. So why does that buttress their stock? Because they actually have an expense coming in.
Yeah, so I think the way this is setting up, we're spending a lot more time now talking about capital expenditures. And I think one of the dynamics that is at hand right now is that you're seeing a lot of the investment into AI and related applications, and the semiconductor component of that fills that quite directly, as does the software component. And so we're watching this AI narrative unfold through two paths. The first is you're going to have companies that are directly exposed. These tend to be your Mag 7 or Big 7 components, where we're going to be measuring them directly on the way AI is feeding their fundamentals in the months to come. On the other hand, the bigger picture, and perhaps the more important longer-term picture, is that now as more and more companies embrace the opportunity in generative AI, they're putting a lot of effort into establishing their own ways of benefiting from AI. What this is going to mean over time is that the investment and spending that's unfolding right now should translate into various forms of productivity enhancement, perhaps margin improvement, and ultimately what we really want to see is profitability enhancement, which in turn leads to higher valuations. All told, the setup is very clear right now. It's going to play out over, as I mentioned, months and perhaps in some cases over the next couple of years. But what it's doing is providing the broader market, as we mentioned at the outset, a very compelling longer-term growth opportunity that is taking fundamental expectations over and above traditional economic sensitivities.
How much time do we have before they have to deliver on that productivity?
It's going to vary. We think for some of the more direct beneficiaries, they need to start showing it in the months and quarters to come. For companies where it's going to be more of a productivity enhancing application, we're going to be watching for that, I think, probably as 2025 kicks in and beyond. So it's going to be in some cases months, quarters, in other cases we have to give companies a couple of years to build these products and services and productivity enhancement.
Scott, thanks so much. That's Scott Chronert, Citi US Equity Strategist. China is on everyone's minds right now, where it's going, where its economy is, where investment opportunities may be. Henry McVey, he's the CIO of KKR Balance Sheet, goes around the world and travels to places like China, comes back with reports, and he's just come back from China right now, and we welcome him back now to Wall Street Week. So Henry, great to have you back with us. We've done different countries, we've done Japan, we've done India, now let's do China.
Great.
Just coming back, what did you learn?
You know, I'd say on the positive, the economy is bottoming. We heard a couple of different data points, I think, from companies in the logistics business that are seeing the U.S. consumer pick up a bit. So that was a positive. And I do think things have bottomed also in Europe, and there's a little bit more demand. But overall, it's still a pretty sluggish economy post-COVID with very low inflation.
And the growth that is there is not evenly distributed. There are some areas growing much more than others, as I understand it.
Yeah, we've spent a lot of time. I've actually been to China 4 times in the last 5 quarters. So I'll give you how I think the evolution of the economy is changing. Really, a lot of people focus on fixed investment. They focus on exports. I think the Chinese government is really repositioning the economy towards a couple of different things. One is this whole idea of digitalization, particularly as it relates to the industrial sector. They're trying to automate that sector to be more effective and more competitive globally. In the past, I think a lot of people thought about China in terms of e-commerce, Alibaba, domestic consumption. The focus right now from the government really is on industrial automation. China today actually has about half the world's robots on the industrial side, which is an amazing statistic. The second big driver is around the green effort, and they're trying to really dominate batteries, EVs, and solar panels and that, and they're trying to export some of that globally. So those are really the growth drivers. The offset, which is still problematic, is around housing, and our estimate is they have somewhere between kind of 20 and 30 million too many homes, and so they're trying to clean that out right now, but that's a disinflationary force, and it clearly has an impact on domestic psychology as well.
Some of what China is investing in the green transition has gotten the attention of places like the United States and Europe, whether it's solar panels or batteries or EVs, because there's a concern of a build of overcapacity. Yeah. Do you see overcapacity, and what does that do to margins?
I think what's going to happen around the world right now is that industries such as autos are going to become of national interest. We've already seen that in technology, could expand into other sectors. So there's definitely going to be sensitivity. You saw President Biden talked about increasing the tariffs there. Europe, I think, is going to do a similar type of strategy. So you can have capacity. The question is where can that capacity go? I think probably if you're China, you'll see more of it go into places such as Latin America, other places, maybe Eastern Europe, where they have partners that maybe there's increasing kind of bilateral trade. That doesn't seem to be the case in the U.S. and Europe right now.
So there is growth. You found growth there. As you said, it's bottomed out. At the same time, when you take into account the disinflation, the nominal GDP actually is not growing at the same rate as some other places like Europe and the United States.
If I could give an insight to your viewers, KKR typically has 150 businesses around the world, upwards of 200 now where we operate. You got to focus on nominal revenues, nominal GDP. What does that mean? It's real GDP plus inflation. A lot of times the sell side focuses on real GDP. And what you've seen in China, when I started going there in 1995 and when I started at KKR, nominal GDP was in the teens and 20%. There's a lot of growth and a lot of profit that comes with that. Today, that number is probably about a third of that. So that inflation component has come down. And the second thing is on the real GDP, the productivity has come down in concert with slower labor force growth. So it is a big deal. At the same time, the Western world has put a huge amount of fiscal stimulus into the system, and that's driving a little more inflation and a little more nominal GDP.
Thank you so much, Henry. Always love having you on.
Absolutely.
That's Henry McVey. He's CIO of the KKR balance sheet. Coming up, if we're all going to use generative AI, then we're going to need a lot more power. We talk with former New Jersey governor and EPA Administrator Todd Whitman about whether nuclear power could be part of the answer.
Well, this is where small modular reactors can be perfect because you just can put them there right next to those data centers.
That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. The sprint toward generative AI has turbocharged the move to build data centers, and every one of them needs power, lots of it, with some believing they provide a good use case for those small modular nuclear reactors we've heard so much about. To take us through the possibilities, we welcome now Todd Whitman, co-founder and co-chair of the States United Democracy Center. Ms. Whitman, of course, earlier served as EPA Administrator and as Governor of the state of New Jersey. So, Governor Whitmer, thank you so much for joining us here on Wall Street Week. As you know, generative AI is all the rage these days, at least on paper. And as we talk about that, we talk about a lot of data centers, the need for them, and the need for power. And that has really spurred to the forefront the discussion of those small modular reactors, something you've talked about in the past. Is this a spur to actually get us going on those SMRs?
I certainly hope so, because it is true. Those data centers pull a lot of power. And most people aren't thinking about that. They don't know it. They're beginning to now to understand just how much they draw down on the grid. So this is where small modular reactors can be perfect, because you just can put them there right next to those data centers and provide the power for that particular center. And it makes a whole bunch of sense when you look at the issues that we're facing and the economic price we're paying for what's going on with Mother Nature and the environment. And it is due to changing climate. And I think we all have to recognize that now. And so we need to do what makes sense, but that doesn't crater our economy. And this certainly wouldn't. We can build these things, we can distribute these things, and it makes a great deal of sense. They're mutually supportive.
So it increases the demand, the opportunity for these. What are the hurdles? Because, as I say, you and I have talked about this in the past. You've been an advocate for experimenting and using these in the past. We haven't gotten there. As I understand, there are a lot of plans for them, but I'm not sure any have gotten built yet.
No, they haven't. In Canada, they're moving forward. It's obviously the regulatory hurdles, because we want to make sure that they're absolutely safe. And not all of those are federal. A lot of those regulatory roadblocks, as it were, or things that slow it down, which, as we all know, costs money, are local or state regulations. And we've got to respect those. But I think what we're seeing now is the pressure coming that is going to, I believe, as you mentioned, perhaps spur an effort to move these things through, not to cut any corners, but to make sure that you're not holding anything up unnecessarily, because they have a proven technology. They are easier to build. They're much safer to use, they're easier to use, and they can be used in discrete ways, such as putting them next to a data center and having them supply the power for that data center.
You're very familiar with the regulatory structure, and it was put in place for various reasons. With the very large nuclear reactors, do those same considerations apply with the small modular reactors? Should it be the same regulatory system, or should it be an entirely different way of approaching regulation?
It wouldn't be entirely different, but certainly the way these things are constructed is entirely different, and that needs to be recognized from the regulatory perspective. So that there are vast differences, but because you're talking nuclear, and people are very concerned, even though our history with nuclear has been extremely safe, you have to answer those questions. And so the NRC needs to take a step back and say, okay, let's really look at the SMRs, the small modular reactors, and identify they use a different kind of material. Some of them are molten salt reactors. That's entirely different way of producing the nuclear power. They're done in one place, which again is entirely different. You're not moving pieces sequentially to a site. You move the whole thing to a site. All those things, it is a different process, and it does need to be handled differently. I'm just not sure that the NRC at the moment, and I don't know, I'm not saying they're not looking at what they need to do to update the regulations, but they certainly should be.
Governor, put this in the larger context of the climate, something you've been very outspoken on when you were governor of New Jersey, when you were administrator of EPA, and since then. If we in fact build all of these data centers and do not use something like small modular reactors, what is the possible risk for the environment with respect to the use of fossil fuels?
It's huge, because the demand for power of these data centers is enormous. And you're going to go to the fastest, cheapest power, and that's going to put more pressure on opening more coal and not closing coal. And the thing that I think you and I have talked about this, David, that the thing that we're missing here is the understanding that nuclear can be the bridge if we ever get to making making our renewable power, base power. It's going to take a long time before we can rely solely on wind, sun, the various forms of green power. And so we need a bridge. And this is the best way, to my mind, to do this pretty quickly.
Many thanks to Christine Todd Whitman of the States United Democracy Center.
I thought Hamilton had it right. He said a national debt could be a national blessing. And the national debt, having a liquid market there, provides a good benchmark for the private sector. Mm-hmm. It probably underpins the role of the dollar in the world. It allows the Fed to conduct monetary policy easily. I think we have to keep in mind the costs of paying down the debt. There is, among some people, a single-minded focus on it. But there's no free lunch in this world. world. And eliminating the national debt, while it may sound attractive, has its costs as well. The president, by the way, in his program is paying down as much debt as we can retire in the next 10 years. We're moving in that direction, but whether we should pay it all off, I think is a more open question.
That was Larry Lindsay, director of the National Economic Council under President George W. Bush, appearing on Wall Street Week back in March of 2001, back when the concern was about possibly having too little federal debt rather than too much. To take us through our current, very different situation, we welcome back now Nobel Prize-winning economist and New York Times columnist Paul Krugman of the Citi University of New York. So, Dr. Krugman, thank you so much for being back with us. As I say, it was a very different time then when they thought we may eliminate the national debt. But now we're hearing a lot from people saying they're concerned it's gotten to be too big. Is it too big? Is it a problem for our economy right now?
Okay, so first of all, I mean, that was silly even then. I mean, there were, revenues were temporarily swollen by the dot-com bubble and all of that. And, even in 2001, we knew that people like me were eventually going to hit 65 and start collecting benefits. So, it's... So that was a little bit silly to be concerned about that back then. Right now, the debt per se is not really a serious problem. I mean, it's a big number, $34 trillion or something like that. But if we actually look at, what does it cost to service that debt? Well, interest rates are still below the economy's growth rate. And so as long as other non-interest spending and tax receipts are more or less in line, then the debt is really not, it's not a problem to continue servicing it. There's really no reason why that should be an issue. But what is a problem, of course, is that government spending and tax receipts are not in line. And so the fundamental problem is not the debt. The fundamental problem is that we are not managing to pay our way. We're not actually adjusting our inflow with our outflow.
Well, one way of putting it, I suppose, is not the debt, it's the deficit. It's how much we're actually coming up short each and every year. And I think last year it was something like 8.8% of GDP was in deficit. And this is a time when unemployment was very low, by the way. And the growth was good.
Yeah, some of that was interest payments, and really it's the primary deficit, excluding interest payments. But that is a serious problem. We do have an ongoing large primary deficit. Some of that, there were, the year-to-year fluctuations. There's quirky stuff that can move the deficit around. But in a fundamental sense, we're not living within our means at the federal level. And that doesn't necessarily signal any kind of immediate crisis, but it does say that, hey, something's got to give, but the trouble is, what's going to give? So, yeah, that is the real problem is not the numbers. The real problem is that we are not politically, apparently, able to reach any kind of agreement on how to live within our means.
Not an immediate crisis, as you say. At the same time, I remember back in the early 90s when we talked about bond vigilantes, and there was the discussion within the Clinton administration, actually, about the issues with the bond market. At what point is it possible that the bond market might send a powerful message to us? We talked to Paul Ryan recently, who said he thinks that it's quite possible in the next administration, whoever is president, they could be faced with what he would call a debt crisis. Does that sound reasonable to you?
Not particularly, and I'm not sure I know why Paul Ryan would know this any better than anyone else. But the truth is, I've looked at, I've actually put in a fair bit of work myself on what's the historical record of countries that borrow in their own currency experiencing that kind of debt crisis, a strike by lenders, something like that. What are the historical examples of that happening? And there's almost no examples of that. I mean, you end up saying, well, maybe France in 1926. I mean, Japan has had huge debt for decades now, huge persistent deficits, still no crisis. It's actually, I think we should focus less on what's the risk of a single dramatic event and more on the kind of gradual erosion of confidence that comes from the fact that we can't seem to get our act together.
There's no doubt that there are a lot of political challenges, but before we get to the political challenges, what about what the right answer would be if we didn't have to worry about the politics? I mean, there were times in which we actually did cut the deficit, right? Under George Herbert Walker Bush, there was a bipartisan effort that was made at Andrews Air Force Base. And then under President Clinton, it was not bipartisan, actually. The Democrats did it themselves. They cut back on the deficit. What is the right thing to do? Is it more taxes? Is it less spending? Or is it all of the above?
There is no right answer. What we know from cross-national comparisons is that it's certainly possible to have a thriving economy with a lot more taxes than the United States. The United States is near the bottom in terms of tax receipts as a share of GDP among advanced countries. So we could be raising substantially more money, and there's no real indication that higher tax rates would be a problem for U.S. economic growth. On the other hand, we don't have to provide essential health care to everybody. That's not a question of economic rightness or wrongness. It's a question of your values. We don't have to provide adequate retirement income to everybody. Again, that's not an economic imperative. So you can't actually divorce this from politics. This is all about the political decision. Are we going to try to close this gap by making mostly the lives of older Americans tougher? Or are we going to do it by raising taxes, but probably, that includes raising taxes on the rich, but probably also at least a little bit more taxes on the middle class.
I'm delighted to say Professor Krugman will be staying with us as we turn from the fiscal issues that will face whomever is chosen to be the next president to what differences that choice will make for the economy. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. Dr. Paul Krugman of the Citi University of New York and the New York Times has remained with us. So, Dr. Krugman, let's look forward to this election we have coming up in November and what economic choices the American people will be making as they go to the polls. Give us your sense of how different these two people, that is Joe Biden and Donald Trump, are in their approaches to the economy.
Okay, so this is one of those cases where if you look at past experience, you would say, well, how much difference does it make? In a lot of ways, the economy of 2024 looks a lot like the economy of 2019, pre-pandemic. Full employment, fairly low inflation. It's, worrying a little bit, but we're worrying about the difference between 2 and 3, not anything major. It doesn't look as if it has made a whole lot of difference who's in the White House. But if there's a Trump 2, then there's a lot of reasons to believe that it could be very different. What's amazing if you go back and look at Trump's first time in the White House was how little he did when all is said and done. Basically he got a moderate-sized tax cut through, sort of, period, end of story. There wasn't a lot else that went on. That's largely because there were institutional restraints. There were, they couldn't get stuff through Congress, couldn't tell the Federal Reserve what to do. That could be very, very different right now. And if you take seriously what Trump, former Trump aides are saying, it would be very, very drastic. Biden would do continuity. Biden, if he can do it, will do more, some further tax increases, some more green industrial policy, but probably not enough to make a huge difference to the macroeconomic numbers. Big differences in other respects. Trump, we know that one of his former aides has been talking a lot about rounding up millions of immigrants. Supposedly undocumented, though it wouldn't be surprising if a lot of legal immigrants got caught up in the net as well and deporting. Huge economic impacts, huge disruptions to the labor force. Another, Peter Navarro, who's being interviewed from jail, but has said that Jay Powell will be fired within 100 days. And that we will basically have the politicization of monetary policy. And there's a lot of reasons to think that a Trump second term might see him become one of those autocrats who demands that you run the printing presses for his political gain. I mean, think of Erdogan in Turkey or something like that. It's huge uncertainty, but I think anyone assuming that a second Trump term would look like the first one with what ended up being fairly conventional economic policies, nothing, and the Federal Reserve keeping a lid on things, could be in for a very rude shock.
Picking up on your comment about monetary policy and Fed Chair Jay Powell, we had Ken Rogoff on, somebody you know well, a fellow economist. Yeah. And when I asked that question of him, he said the markets would not let a new President Trump do that they would react really strong in the Treasury markets, and he would not have that option. Is that plausible?
The markets would certainly react. We would probably see acceleration of inflation, a plunge in the dollar, but, how does he respond to that? I mean, again, if you look at much smaller countries with that are much more exposed to market pressure, like Turkey, authoritarian leaders have a habit of saying, well, the markets are wrong, and I'm going to order them to stop. You might be surprised at how much socialism, or at least in the sense of capital controls and other things that might happen. If Trump says to the Fed, I want a booming economy, I want you to roll the printing presses, and the markets respond by driving the dollar down and inflation up, he might well then say, well, I'm going to put on rules that stop that from happening rather than changing the policy. Remember, we've had one, since the immediate aftermath of World War II, we've had only one episode of price controls in America, and it was Richard Nixon, not some progressive Democrat who did it. So I think you want to be, I understand Ken's point. He thinks that the bond vigilantes basically would discipline Trump, but I don't think that's a safe bet.
What about the prospect of inflation? Obviously, tariffs tend to be inflationary rather than disinflationary. At the same time, both President Biden and former President Trump seem to like tariffs pretty well.
Well, there's a big difference. I mean, yes, both are doing tariffs, and Biden has not rolled back most of the Trump tariffs, which is politics. There doesn't want to be accused of being soft on China or something like that. But if you look at the new proposals, they're actually, although they both are proposing tariffs, they're very different both in the details and in the purpose. So Trump's view is clearly he thinks of trade as a zero-sum game. If we win if other people buy our stuff, we lose if we buy other people's stuff. And so he wants to put a ring around the collar. He said a 10% tariff on everything, and and maybe more for some other countries. That's not at all what Biden is doing. What Biden is doing is some selective tariffs aimed at what he perceives as strategic sectors.
And if I'm not mistaken, you generally support the notion we have to do, whoever the president is, something to have to do to prevent a second, as you call it, China shock, such as we saw really around the time of the WTO, in order basically to protect some of our workforce.
Yeah, it's not so much jobs in the aggregate. Sorry, I'm sounding like an economist there, but it's not so much the total employment. We're not having a problem, at least at the moment, with overall employment. But what we learned rather painfully from the first China shock was that sudden surges of imports can be disruptive in ways that a lot of standard economic models don't capture, although non-standard models do. They can disrupt communities. They can disrupt strategic industries. And particularly if you are doing what Biden is doing, which is to try to sell climate policy in part by saying it creates manufacturing jobs, the political basis for that is going to be undermined if it ends up creating manufacturing jobs in China. So, this is China, I don't think the Chinese seem to fully realize, but they are having a situation of grossly inadequate domestic spending and relative to their production capacity, and seem unwilling to boost their own demand, and they want to dump both in the sort of common language sense and probably in the legal sense. They want to dump the excess production on the rest of the world, and it's not going to happen. We're not going to accept it. The Europeans are not going to accept it. So you have to do something.
Professor, it's always such a treat to talk to you. Thank you so much. Many thanks to our Nobel Prize-winning economist, Paul Krugman. If opportunity doesn't knock, build a door. That was the advice of comedian Milton Berle. For the last few years, employers have been knocking on the doors of job seekers with opportunity.
Growth is slowed, but our labor market continues to be quite strong.
And there are still firms on the hunt for more employees to expand their businesses, like in private credit at Ares.
Our differentiator is our ability to be in these local markets, developing relationships with companies and assets. So by definition, we have to grow our headcount in order to support the AUM target.
And generative AI has brought to life a whole new job category of something called an AI prompt generator.
I think there'll be all kinds of jobs that AI will create that we don't even know about, like, prompt engineer is a new job category. There's already lots of prompt engineers. There's going to be many more prompt engineers.
Now that may be changing. Some of those job opportunities are drying up. TikTok employees this week learned there will be about 1,000 less of them in their operations and marketing teams. Disney told Pixar that it was laying off 14% of the staff that gave us Toy Story and Ratatouille.
I need this job. I've lost so many. I don't know how to cook, and now I'm actually talking to a rat as if you... Did you not? You understand me?
And Red Lobster employees at restaurants across the country showed up for work only to find locked doors as the chain went into bankruptcy.
Now, seafood chain Red Lobster has filed for Chapter 11 bankruptcy after facing higher costs and a disastrous unlimited shrimp promotion.
But at this time of year, we're particularly mindful of our college graduates, for whom that Milton Berle advice about building a door may be all too poignant. Members of the class of 2024 have not had it easy from the beginning. They graduated from high school at the height of the pandemic, relegated to virtual graduations with no hope of a senior prom or senior prank. Many of them started college with remote learning and picking up box meals from closed cafeterias. To be sure, they got to see the COVID vaccine turn things around dramatically. But just as they approached their first real graduation, one they would be able to attend in person, the war in Gaza interrupted life on many college campuses, leading to graduation ceremonies that have been marred by protests or canceled altogether at places like Columbia.
Columbia University today canceled their main commencement event for this school year, following protests on campus in reaction to the war in Gaza.
But however they got here, they now, at least most of them, have their college diplomas, only to be faced with a changed and changing job market. Particularly in finance and consulting and technology, firms are cutting back on their overall hiring. And those who already have the jobs are less likely to give them up.
The other question is, should we reevaluate how we work and how long we work?
It's easy for those of us at the other end of our careers to say to those starting out that something better lies around the corner of many disappointments. At the beginning of my career, I was working for a judge in New York and wanted nothing more than to be hired as a law clerk for Supreme Court Justice Lewis Powell. I knew former clerks of his, had studied his career and his decisions, and he was the one justice I dreamed of working for. I got an interview at the court, took the train down to Washington, spent time with him and his clerks in his chambers. He was a reserved man, and I did not get any real sense of whether I had a chance or not. So a couple of weeks later, I was devastated to learn that he'd extended an offer to another clerk on the Second Circuit. I was certain that he wouldn't take two of us from the same court. I resigned myself to going in a different direction. So you can imagine my joy when I eventually got a call and Justice Powell's longtime assistant Sally Smith asked me to hold for the justice. It turned out that I got what I'd wanted all along. It just took me a bit longer and a bit of emotional turmoil to get there. Now, I'm not saying it always works out that way. Often it doesn't. But I do know that regularly in the course of a career, what seems like a wall turns out to be a door after all. There may be a Sally out there giving us a call when we least expect it. That does it for this episode of Wall Street Week. I'm David Westin. See you next week.